Somewhere, right now, a central bank is quietly buying gold, not for jewelry, not for tradition, for war. A war fought without soldiers, without headlines, without a single shot fired. The battlefield is the bond market. And the casualty may be the very currency in your wallet. For decades, one asset backed the modern financial world. That asset is now being sold, quietly, aggressively, by the very nations who once trusted it most, and in its place, something older, something harder to fake, is rising. Some analysts call it a rotation. Others call it something far more serious, a monetary reset. Tonight, we ask the question very few are willing to say out loud. Is the era of paper money ending? Stay until the end. Because what happens next could change how the world defines money itself. Welcome back to Precious Metals Intelligence, the channel dedicated to helping serious investors, professionals, and decision makers understand the strategic forces quietly reshaping the global economy long before they reach the headlines. Before we begin, we'd love to know, where are you watching from today? Drop your city or country in the comments below. It always means a great deal to see how far this conversation reaches. For most of modern history, one asset has quietly held the entire financial system together. It is not gold, it is not the dollar itself, it is government debt, specifically the bonds issued by the United States Treasury. Few people ever think about bonds. They are not exciting. They do not trend on social media. But for decades, they have been the foundation stone of global finance. Banks hold them as reserves. Pension funds hold them as safe, stable investments. Central banks around the world hold them as the ultimate backup asset, the thing they trust when everything else feels uncertain. This trust did not happen by accident. It was built over 80 years. After the Second World War, the world agreed to organize its financial system around the U.S. dollar and U.S. government debt. Nations believed that America's economy was strong enough and its government reliable enough that lending it money was close to risk-free. That belief became the invisible architecture of the entire global economy. But architecture, no matter how strong, can weaken over time. And right now, analysts across the financial world are pointing to a strange and uncomfortable pattern. The bond market is behaving in a way it should not. Under normal conditions, when a government or its central bank wants to keep borrowing costs low, it has tools to do that. It can buy back debt. It can adjust interest rates. It can send signals to reassure investors. For decades, these tools worked exactly as intended. When trust is high, yields, the interest rate a government pays to borrow money, stay low and stable. But something has changed. Despite continued efforts to stabilize the bond market, yields have been climbing. Not gradually and not quietly. They have moved in ways that catch even experienced investors off guard. This matters more than most people realize, because rising yields are not just a number on a screen. They are a signal. They tell a very specific story. When investors demand a higher yield to hold a government's debt, it usually means one thing: they are less confident that the debt will hold its value over time. It does not mean they think the government will collapse tomorrow. It means they are starting to ask questions they did not ask before. Questions about how much debt is too much. Questions about whether the currency backing that debt will still be worth the same amount in 5 years or 10. This is the part of the story that rarely makes headlines because it does not happen overnight. It happens slowly, in small movements and quiet decisions made by large institutions rather than everyday people. But when many of those small movements start pointing in the same direction, they stop being noise. They become a pattern. And patterns, especially in bond markets, tend to matter far more than short-term price swings. There's a reason professional investors watch bond yields more closely than almost anything else. Stock markets can rise and fall based on emotion, speculation, or short-term news. Bond markets are different. They are driven by long-term calculations about safety, trust, and repayment. When bond markets start sending warning signals, it usually means something deeper is happening beneath the surface of the economy, something that has not yet reached the average person's daily life, but eventually will. This is exactly why so many financial professionals are paying close attention right now, not because they believe in panic and not because they want to create fear, but because the signals coming from the bond market are the kind that, historically, have preceded major shifts in the financial system. Shifts that reshape how nations manage debt, how they store wealth, and how they trust one another economically. For decades, government bonds were seen as the safest possible place to store value. That perception has quietly begun to shift. And once large institutions, and the ones responsible for protecting national wealth, start to lose full confidence in that safety, they do not wait around to see what happens next. They begin looking for alternatives. Something is moving beneath the surface of the world's most trusted financial asset. And as the next part of this story will show, the world's largest institutions have already begun quietly responding, not with words, but with action. While most investors were watching stock prices and daily headlines, a very different kind of activity was taking place far away from public attention. Central banks, the institutions responsible for managing a nation's money and reserves, were buying gold. not in small amounts, not occasionally, but steadily, month after month, at a pace not seen in modern history. This is not the kind of buying that gets attention from casual investors. Central banks do not announce their strategies on social media. They do not explain themselves to the public in simple terms. Their decisions are made quietly, in meetings most people never hear about, based on calculations most people never see. But when those decisions are added together over months and years, they reveal something important. For a long time, the standard approach for a central bank was simple: hold a large portion of national reserves in U.S. government bonds, trust that this debt would remain stable, liquid, and safe. This approach worked well for decades, largely because trust in the U.S. financial system was strong and largely unquestioned. That approach is now being reconsidered. Slowly, and without much public explanation, many central banks have been shifting a portion of their reserves away from government bonds and into physical gold. This is not a small technical adjustment. It represents a meaningful change in how these institutions think about safety. To understand why this matters, it helps to think about what a central bank actually wants when it holds reserves. It wants an asset that will not lose its value, no matter what happens in the world. An asset that cannot be devalued by another country's decisions. An asset that does not depend on trust in any single government's promises. Government bonds, by their very nature, depend on trust. They are essentially a promise that the borrowing government will repay its debt, and that the currency used to repay it will still hold real value. For most of modern history, that promise was strong enough that few questioned it. Gold works differently. It is not a promise from any government. It does not rely on the financial health of any single nation. It has held value across centuries, across different currencies, and across different political systems. This is exactly why, when trust in paper promises begins to weaken, institutions with long-time horizons tend to look toward gold. What is happening now is not sudden panic. It is something more deliberate. Central banks are not reacting emotionally to short-term news. They are making long-term positioning decisions, the kind that unfold over years rather than days. This is precisely what makes the pattern so significant. Panic buying tends to be loud and temporary. Strategic buying tends to be quiet and lasting. Many financial professionals describe this shift as a form of de-risking. In simple terms, it means reducing dependence on a single system, a single currency, or a single set of promises. Just as a business owner might avoid relying on only one customer or one supplier, a central bank may choose not to rely too heavily on one nation's currency or debt to protect its country's wealth. This shift also carries a symbolic weight that goes beyond financial mechanics. For nearly a century, holding U.S. government debt was seen as a sign of confidence in the American-led financial order. A steady move away from that debt, even a gradual one, suggests that some of the world's most powerful financial institutions are preparing for a different kind of future, one where reliance on a single dominant currency is no longer guaranteed. None of this means collapse is coming. It does not mean the U.S. dollar is disappearing or that government bonds are becoming worthless. What it does suggest is a slow, careful repositioning by institutions that plan decades ahead, not days ahead. This raises an uncomfortable but important question. If the world's central banks, the very institutions trusted to protect national wealth, are quietly reducing their reliance on traditional government debt, what exactly are they preparing for? Most everyday investors are still focused on short-term price movements, daily headlines, and market noise. But the institutions making these decisions are not thinking in days or weeks. They are thinking in decades. And their actions suggest they may be seeing something on the horizon that has not yet become visible to the general public. As the next part of this story will explore, this quiet shift in strategy is not happening in isolation. It is part of a much larger realignment taking place across the global economy, one that stretches far beyond any single institution and touches the very structure of international power itself. For most of the last century, economic power in the world followed a fairly clear pattern. Wealthy nations in the West, led primarily by the United States, set the rules for global trade and finance. Other countries adapted to that system because it was the most stable and widely accepted option available. This arrangement lasted for generations, and few people questioned whether it could change. That pattern is now shifting, and it is shifting in ways that go far beyond any single headline or policy announcement. Countries outside the traditional Western financial order have spent years quietly building alternative systems. These systems are not designed to compete loudly or dramatically. They're designed to slowly reduce dependence on the existing structure, piece by piece, until the reliance that once seemed unavoidable no longer feels necessary. This kind of change rarely looks dramatic while it is happening. It does not arrive as a single dramatic event that appears on the evening news. Instead, it appears as small, technical decisions. A new agreement between two nations to trade in their own currencies, instead of relying on a third currency to complete the transaction. A new financial institution created to settle payments without depending on systems controlled by other countries. a new infrastructure project that allows two economies to work together without needing approval or cooperation from outside powers. Individually, each of these steps can look minor. Analysts might dismiss them as small technical adjustments with little real impact, but when many of these steps happen at the same time, across many different countries, they begin to form a much larger picture. What looks like a series of small, unrelated decisions is often the early stage of a much bigger structural shift. One of the clearest signs of this shift is the growing effort by several major economies to reduce their dependence on a single dominant currency for international trade. For decades, doing business across borders almost always required using that one currency, regardless of which two countries were actually involved in the transaction. This gave enormous influence to the country whose currency was being used, because it meant that countries' financial decisions affected trade far beyond its own borders. Now, more countries are building direct trading relationships that bypass this requirement entirely. They are creating new payment systems, new settlement networks, and new financial partnerships that allow them to trade directly with one another. This does not eliminate the old system overnight, but it steadily reduces how essential that system is to global commerce. This kind of change matters because financial infrastructure, once built, tends to be very difficult to reverse. Once countries have created new ways of trading, settling payments, and storing wealth outside a single dominant system, they rarely go back to full dependence on the old one. The infrastructure becomes part of how business is done, and over time, more countries choose to join it simply because it already exists and already works. This is part of what economists mean when they describe the world as moving toward a multipolar system. In simple terms, this means power and influence are no longer concentrated in one place. Instead, several major regions each hold significant economic weight, and no single country can fully dictate the terms for everyone else. This is a very different world than the one that existed for most of the last 80 years. It would be a mistake to view this shift as sudden or accidental. The countries leading this change have been building toward it patiently, often over the course of many years, without drawing much public attention to their long-term goals. They have not needed to make loud announcements, because the infrastructure itself speaks for their intentions. Every new settlement system, every new trade agreement, and every reduction in dependence on outside currencies adds another piece to a much larger structure. For business professionals and investors watching from the outside, this realignment carries serious implications. A world organized around a single dominant financial system behaves very differently from a world organized around multiple competing centers of economic power. Rules change, alliances shift, and assets that were once considered universally safe may not hold the same status they once did. This is precisely why so many long-term investors and institutions are paying closer attention to physical assets that do not depend on any single country's currency or political system. As global power becomes more distributed, the appeal of assets with a long history of holding value across different political and economic systems tends to grow stronger. Infrastructure changes quietly, one small piece at a time, but it eventually reaches a point where its cumulative effect is impossible to ignore. As the next part of this story will show, this global realignment does not exist separately from the pressures building inside the United States' own financial system. In fact, the two forces are deeply connected, and together they are creating a feedback loop with consequences reaching well beyond financial markets. Every financial system eventually faces the same basic question: how does a nation pay for what it has already promised to pay? For the United States, this question has become increasingly difficult to avoid. The national debt has grown to a level that would have seemed almost unimaginable a generation ago, and much of that debt now carries a much higher cost than it once did. To understand why this matters, it helps to think about debt the way a household might think about a large loan. When interest rates are low, carrying a large loan is manageable. Payments stay predictable, and the burden feels light. But when interest rates rise, the cost of carrying that same loan increases sharply, even if the total amount borrowed has not changed. The government faces this exact problem, only on a much larger scale. A significant portion of U.S. government debt must be refinanced on a regular basis. This means old debt does not simply disappear. It must be replaced with new debt, borrowed at whatever interest rate exists at that moment. When rates were low for many years, this process was relatively painless. Now that rates have risen, refinancing this debt costs far more than it used to, and a large amount of debt is scheduled to be refinanced in the near future. This creates a difficult financial position. The government must pay significantly more simply to maintain its existing obligations, without necessarily borrowing for anything new. Interest payments alone have grown into one of the largest expenses in the entire federal budget, competing with spending on essential public programs. Faced with this pressure, governments generally have a limited number of choices. They can raise taxes significantly, which is politically difficult and slow to implement. They can cut spending sharply, which is equally difficult and often unpopular. Or they can rely on their central bank and financial system to manage the situation by keeping money relatively easy to borrow and by allowing the currency to gradually lose some of its value over time. This last option often becomes the path of least political resistance, even though it carries a serious hidden cost. When more currency is created or made available to manage debt burdens, each unit of that currency tends to buy less over time. This is commonly known as currency debasement, and its effects are felt gradually rather than all at once. For everyday individuals and business owners, this process rarely appears as a single dramatic event. Instead, it shows up quietly in rising prices for everyday goods, in the shrinking purchasing power of savings, and in the sense that income never quite stretches as far as it once did. Many people experience this reality without ever connecting it directly to decisions made about government debt and interest rates. This is often referred to as an invisible tax because it is rarely voted on, rarely announced, and rarely explained in simple terms. Yet its effects touch nearly everyone who holds savings in a currency that is gradually losing value. Unlike income tax, there is no clear bill or statement showing exactly how much has been lost. It simply appears over time in the form of reduced buying power. This creates a difficult cycle. As debt grows, the cost of servicing that debt increases. As the cost of servicing debt increases, pressure builds to manage that cost through currency creation. As currency creation continues, its value gradually declines, and as its value declines, the real cost of previous debt becomes easier to manage at the direct expense of anyone holding that currency as savings. This is not a temporary condition tied to one particular year or one particular policy decision. It is a structural pattern that tends to repeat throughout history whenever large economies face similar levels of debt and rising interest costs. Recognizing this pattern is essential for understanding why so many long-term investors and institutions are reconsidering how they store and protect wealth. As the final part of this story will explore, these pressures do not remain isolated within financial markets or government reports. They eventually reach the daily decisions of ordinary investors and business owners, shaping how wealth is protected in a world where trust in traditional financial promises is being tested more seriously than at almost any point in recent history.